Today, Bitcoin and Ether tick higher. Genesis reportedly hires a restructuring firm as bankruptcy risks loom. And with so much focus on crime in the crypto industry right now, we explore why it's so hard to prosecute crypto insider trading. Welcome to CNBC's Crypto World. I'm Pippa Stevens. Digital currencies rising alongside modest gains on Wall Street this morning. By noon Eastern, Bitcoin traded firmly above $16,000 and Ether climbed to $1,100. Meanwhile, the Matic token dipped to 84 cents. All right, let's catch you up on the top stories. First up, Genesis could be inching closer to bankruptcy. The crypto lender just hired investment bank Moelis & Company as a restructuring advisor. The bank will reportedly help the firm explore several options to stabilize its business, including a potential bankruptcy. The crypto lending unit of Genesis faced a liquidity crunch in the aftermath of FTX's implosion, thanks to $175 million in assets that the lender had on the exchange. Those frozen funds led Genesis to halt customer withdrawals on its own platform. And then as recently as this week, the company reportedly warned that it could face bankruptcy without new funding. Next, despite the recent turmoil in digital currencies, El Salvador is doubling down on its vision for a crypto economy. Lawmakers there are considering a bill that would create a regulatory agency focused on digital assets. It would also create a legal framework for public issuances that use digital assets. Basically, that means it helps pave the way for Bitcoin-backed bonds. These so-called volcano bonds, as they're known, have been a promise of the country's president Nayib Bukele since last year. He's been instrumental in El Salvador's adoption of Bitcoin as legal tender, and he hopes to raise $1 billion with these bond issuances. Last, New York state lawmakers are moving forward with their own crypto regulation. Governor Kathy Hochul signed a 2-year moratorium on new proof-of-work mining projects in the state unless they use 100% renewable energy. Now, this doesn't affect Bitcoin mining operations that are currently up and running, but if they need to renew their permit, well, they won't be able to for the next 2 years unless they convert to renewable energy. The new law is part of efforts to cut down on the state's carbon footprint, but crypto industry experts say the law could have a harmful ripple effect across the U.S., which accounts for nearly 40% of the world's crypto mining operations. Okay, on to our main story. The implosion of FTX sparked renewed scrutiny on digital assets and launched debates over how little oversight there is for crypto businesses and investors. A report from the Wall Street Journal picked through public data from Argus to find that FTX's sister company, Alameda Research, hoarded several cryptocurrencies before their public listing on the exchange. Details of this practice led some to question whether this was insider trading. Crypto market manipulation, like insider trading, has gotten more attention this year than ever, but it's still rarely prosecuted. Crypto World took a look at what makes these cases so hard to pursue.
Back in July, the U.S. Securities and Exchange Commission charged a former Coinbase employee in crypto's first ever insider trading case. The case was seen as a huge step for the agency in its attempts to regulate crypto through enforcement action, and many thought it could signal a wave of crypto insider trading cases to come. But heading into the end of 2022, that wave never happened, despite several studies suggesting that evidence of insider trading is hiding in plain sight right on public blockchains. A study from the University of Technology Sydney, published in 2022, estimates that for every 100 token listings, there were about 10 to 25 instances of insider trading activity. In traditional markets, that number is more like 5 out of every 100 earnings announcements. So why aren't there more prosecutions of insider trading in crypto?
There hasn't been a judicial determination that any crypto asset is a security yet, other than some lower court opinions that haven't definitively defined or definitively found that. So in terms of who is policing it, it's a little different right now. There's some uncertainty.
To sort of stoke that fire is also the perception that crypto markets are lawless. So you have a lack of regulation in a sense, or not very clear regulations, and then there's no consequence seen for the misconduct. So it's hard to, as a participant, if you have insider information, you can sort of sit there and go, hey, I'm actually able to trade off this and profit quite easily.
So how does crypto insider trading work, and how can the industry and regulators fight back? Insider trading occurs when someone buys or sells a security based on material, non-public information. An insider trading conviction could mean serious time in a federal prison and up to 7 figures in fines.
You are an employee of a company or a project that issues tokens. You know there's going to be a major announcement, like an acquisition, like a merger, like an upgrade, like a technical development, and you buy ahead of that too.
One such announcement is a token getting listed on a major crypto exchange. That alone can help boost the price of a digital asset. Traders who know about those listings can buy in ahead of time on decentralized exchanges. In traditional finance, that's almost like being able to buy a stock before the company goes public.
I would sort of identify it as like the risk exchanges are the ones where you can have those value propositions. Your smaller secondary exchanges, or like low tier exchanges in a sense, where you don't have a lot of liquidity, you don't have a lot of volume. Getting a cross listing on those exchanges aren't as beneficial as, say, your major exchanges like Coinbase, Binance, FTX, where if you're listing on those exchanges, you increase the liquidity for that token in the markets. And then as such, you can just do a better price discovery.
Decentralized crypto exchanges often don't have what's known as Know Your Customer or KYC rules, which require customer identities to be verified. What's different about insider trading in crypto compared to Wall Street is the public nature of blockchains. All trades on DeFi exchanges are entered into public ledgers.
Yes, it is an area where you would think that the government can track that. In terms of determining what the schemes are, that's sort of where it's lacking now, where the government hasn't moved. But once they have a theory, it's very easy to go and look and see if someone bought something and when, and then they could build their case from there in terms of determining, did this person have access to material non-public information in advance of those transactions?
Because crypto is so new, a lot of the guidelines are still up in the air. There's no clear definition of what material non-public information means for crypto, and whether these cryptocurrencies qualify as securities or commodities remains under debate.
Right now, it's a little harder to determine what would be material non-public information. On the non-public side, obviously, anything that you learn, whether you're at a company, so if you're at a coin team, developing tokens, developing crypto, or even at an exchange, which is what happened on the Coinbase side, there's a lot of inside and non-public information you get, but whether you'd be able to use that in any way to profit is a little trickier question than what you might learn about a company's earnings on the stock market or a merger or acquisition. There's the SEC, who now has filed an insider trading complaint against the Coinbase individuals in the Wahi matter. The CFTC has voiced that they have jurisdiction over this also. And then from an overarching standpoint, the Department of Justice can bring any action under the criminal statutes.
Will regulations solve this issue, or will it hinder crypto's claim of freedom and openness?
I think that the vast majority of people who have inside information into crypto are not the people who are in third world countries worried about authoritarian governments. They are people in the United States, in Western Europe, people who are making decisions about what they're going to list on major exchanges, what they're going to invest in as VCs. And so those concerns to me are incredibly important and resonate deeply with me. But these are not the people for whom those concerns are realistic.
With a long road ahead to combat insider trading, what's next?
I think part of that will determine what agency is given control, right?
Generally for markets, it will get better. You sort of start having the 1 and 2 pop-ups that start getting weeded out, the consequences start appearing, and then at least the cost benefit side, as an insider, you start losing out if you can see that you're going to get prosecuted, where once your thoughts may have been, I can get away with this. As we move forward and as at least regulatory oversight starts looking at the space, you'll start seeing a change where at least that one shouldn't be as prominent, one can hope.
Okay, that's all for Crypto World today, but we are back again on Friday after Thanksgiving, and we'll see you then.